Today I am going to discuss about income tax laws. This is a part 1 video, exam oriented topics. The questions here covered here are Wealth Tax Act 1957, scope of wealth and deemed assets, term wealth and executed assets, how to compute net wealth and assets in a wealth tax, constitutional provisions relating to central state taxing powers. Declare under the Central Sales Tax Act and explain the provisions for registration of dealers. Computation of income under the head salaries principles. Wealth Tax Act 1957. Scope of wealth and deemed assets. The income tax levied on, on the income of the taxpayer, whereas wealth tax is levied on the wealth of the taxpayer. Wealth tax is governed by the Wealth Tax Act 1957. It is to be noted that Wealth Tax Act 1957 is abolished with effective from 1st April 2016. Basic provisions. Following are the basic provisions of the wealth tax law which are to be kept in mind. The wealth tax is levied on following persons only, that is an individual, Hindu undivided family and a company. A partnership firm is not liable to wealth tax, but the value of the assets held by the firm is to be ascertained, and this value will be distributed among the partners of the firm and will be charged to tax in the hands of partners. Wealth tax is levied on the net wealth owned by a person on the valuation date, that is 31st March of every year. Wealth tax is levied at 1% of the net wealth in excess of Rs 30 lakhs. Manner of computation of wealth tax. The wealth tax is levied on net wealth owned by the taxpayer on the valuation date. Net wealth, that is taxable wealth of every person, is computed in the following manner. The particulars taken in the calculation of gross wealth tax is first ascertain the value of taxable assets as per valuation rules prescribed in this regard. Then add the assets clubbed with the assets of the taxpayer, that is deemed assets. Now less the exempt assets which are exempted in the wealth. This gives gross value of the asset. Now less less the debt, that is the loans taken to acquire the asset at 1 and 2. This in total gives taxable wealth. The wealth tax is to be paid at 1% on the net wealth in excess of 30 lakhs. No cess or surcharge is levied on wealth tax. Assets covered under wealth tax are: the wealth tax is levied on the value of assets. The term assets is defined under section 2EA of the Wealth Tax Act. Hence, wealth tax is levied only on those properties which are covered in the definition of the term assets as defined in the Wealth Tax Act. The following items are covered in the definition of the term assets: any building or land, appertaining thereto, whether used for residential or commercial purposes or for the purpose of maintaining a guest house or otherwise, motor cars, jewelry, bullion, furniture, utensils, or any other article made wholly or partly of gold, silver, platinum, or any other precious metal or alloy, and any alloy containing one or more of such precious metals, yachts, boats, aircrafts, urban land with some exceptions. Net wealth to include certain assets. Assets transferred by an individual without adequate consideration to any of the following persons shall be included in the net wealth of such individual. That they are those assets transferred to the spouse by an individual to his or her son's wife, and transferred to a person or association of persons for the immediate benefit of the individual, that is to her spouse or her son's wife. Assets belonging to minor child of an individual. Assets transferred under revocable transfer. That means that can be again recovered from where the transfer has been done. Interest in the partnership firm or an association of persons. If an individual transfers his property to his Hindu undivided family, the gift of money made by means of book entries, holder of an impartable estate. In case of property allotted or leased by a cooperative society, to the member of the society, the member will be treated as the owner of the property. In case of property acquired in part performance of a contract, if property acquired as per Section 269 UAF of the Income Tax Act 1961, that means these are the assets which are added into the main assets. In a nutshell, they are like transfer to other persons, minor child, and irrevocable transfers, interest of the partnership firm, transfer to the Hindu undivided family, gifts, holders, and properties leased to a society, and properties acquired in performance of a part of the contract. Constitutional provisions relating to central state taxpayers. The nation's economy depends on the system of taxations. The collection of tax is the most essential part of the nation. The taxation system can lead to revenue mobilization in response to growth and result in revenue growth faster than the GDP. Tax is the source of revenue for the government. India's tax structure has three federal structures consisting of central government, state government, and other local authorities. These authorities impose taxes and duties on individuals and corporate bodies within the country, and the local authorities mainly include municipal parties and the local councils. In a federal constitution, as is the case in India, since there is a distribution of powers between the federal and state governments, the power of tax is an inherent sovereign power of a state to collect a contribution of money or other property from its citizens and the inhabitants of its territory for defraying its general expenditure as taxation as the source of the public revenue. The essential nature of the tax lies in its being a burden or charge imposed by the legislative power on a person or property for public purposes. Taxation proceeds on the theory that the very existence of the government is a necessity and the taxpayer is supposed to receive his just compensation in the protection which government affords to life, liberty, and property. A federal constitution may delineate the taxing power of the federal and constitutional governments. Article 265 of the Constitution provides that no tax shall be levied or collected except by authority of law, but the word law in the sentence comprehended the power of the President of India and Governor of the states to make law by issuing ordinances. The executive as well as the judiciary is powerless to impose any tax. The tax may be in money or kind. Article 246 in the 7th schedule of the Indian Constitution contains the legislative powers including taxation of the union government and the state governments. It contains following three lists covering the various subjects. That is list 1, that is the central list. It contains areas where only the parliament, that is central government, can make laws including the taxation laws. List 2, state list. It contains the areas where only the state legislature can make laws including taxation laws. And list 3, concurrent list. It contains the areas where both the parliament and the state legislature can make laws concurrently. It is vital to notice that this list does not specify any law regarding taxation, and there is no head of the taxation under the concurrent list, and hence the union and state government have no concurrent power of taxation. The Constitution of India has incorporating certain fundamental rights enforced by the court of law. The Part 3 of the Constitution of India, which deals with fundamental rights, but the only provision which expressly deals with taxation power are Article 27, 31, 5B1 of the Constitution of India. Changes in the Constitution were made to improve the taxation system via 101st Amendment of the Constitution. The articles which are amended are 248, 249, 250, 270, 269, 271, 286, 366, 368. The article which is omitted is 268A. The which are inserted are 269A, 279A. The above mentioned changes are essential for the implementation of GST in the nation. The aim to bring about these amendments in the Constitution is to confer simultaneous power on the Parliament and state legislature to create laws for levying GST at the same time on each group action of offer and merchandise and services. It also specifies that Parliament has exclusive power to form laws with relation to GST and interstate transactions. Thus, as per these provisions, central government and state government shall make the CGST and SGST respectively, while the IGST, that is Interstate GST Act, shall be made by central government only. Under GST, there would be only one tax from the manufacturer to the buyer, leading to transparency of taxes paid to the final consumer. So there will be relief in overall tax burden. The case laws are Jagannath Bhak Singh versus State of Uttar Pradesh. Article 31(2) has no application to the taxation law given in Article 31(5)(b)(1). The Article 31(2) would be inappropriate to a taxing statute because the taxing statute does not support to acquire or requisition any property. Ravi Verma Raish versus Union of India. The tax laws are aimed at dealing with complex problems of infinite variety, necessitating adjustment of several disparate elements. The courts accordingly admit, subject to adherence to the fundamental principles of the doctrine of equality, larger play to legislative discretion in the matter of classification. Concluding this, the Constitution of India envisages a sovereign democratic republic to secure to all its people social and economic justice. The Constitution is very important in relation to taxation. There has been the standardization of income tax rates with governing laws enabling common people to recognize the same. This has resulted in ease of paying taxes, improved compliance, and enhanced enforcement of laws. Dealer under the Central Sales Tax Act and explain the provisions for registration of dealers. This is dealt under the following headings: Introduction, why Central Sales Tax is needed, Dealer, who is a dealer, registration of dealer, provisions for registration of dealers. Introduction. What is a central sales tax? An act formulates principles for determining when a sale or purchase of goods takes place in the course of interstate trade or commerce or outside the state or in the course of imports into or export from India to provide for the levy, collection and distribution of taxes on sales of goods in the course of interstate trade or commerce, and to declare certain goods to be of special importance in interstate trade or commerce, and specify the restrictions and conditions to which state laws imposing taxes on the sale of or purchase of such goods of special importance shall be subject. Why CST? The taxes are the primary source of income for the government and are used to maintain the nation. The government imposes different types of taxes on different products and services in a bid to improve governance and improve infrastructure. The central sales tax is an integral component of the tax structure of the country, having been introduced in the 6th Constitutional Amendment. The central sales tax has been a major source of revenue for the government since its inception and is considered crucial in Indian trade and commerce. The central sales tax is an indirect tax, origin-based tax on customers, and is payable in the state where a particular product is sold. Dealer means any person who carries on, whether regularly or otherwise, the business of buying, selling, supplying or distributing goods directly or indirectly for cash or for deferred payment or for commission, remuneration or other valuable consideration, and includes a local authority, a body corporate, a company, a cooperative society or other society, club, firm, Hindu undivided family or other association of persons which carries on such business. A factor, broker, commission agent, Del credit agent or any other mercantile agent by whatever name called, and an auctioneer who carries on the business of selling or auctioning goods belonging to any principal. Registered dealer means a dealer who is registered under Section 7 of Central Sales Tax Act. Every dealer liable to pay tax under this act shall, within such time as may be prescribed for the purpose, make an application for registration under this act to such authority in the appropriate state. Coming to registration, Section 7 of the CST Act gives information on registration of dealers. If the authority to whom an application is made is satisfied that the application is in conformity with the provisions of this Act and the rules made thereunder, he shall register the applicant and grant to him a certificate of registration in the prescribed form, which shall specify the class or classes of goods for the purposes of subsection 1 of section 8. The authority granting the certificate of registration may, by order and for good and sufficient cause, forfeit the whole or any part of the security furnished by a dealer for realizing any amount of tax or penalty payable by the dealer. If the dealer is found to have misused any of the forms referred to in subsection 2A to have failed to keep them in proper custody. Documentation for central sales tax or registration of dealer means getting TIN number. TIN is taxpayer identification number. This is before 2016. After the 2016, GST is the norms after introduction of GST. Mandatory documents required to apply for a TIN registration are ID proof, residence proof, 4 to 6 passport size photographs, address proof, first sale or purchase invoice, duplicate copy of LR, RGR, and proof of payment along with the bank statement, guarantee, security, and reference letter. Nevertheless, the documentation procedure varies from state to state because the state government has the liberty to frame the rules and guidelines and amend them for their people. Computation of income under head salaries principles. The computation of salary income. Definition of word salary. Section 15 deals with basis of charge of salary income and the characteristics of computing salary income. Computation of salary income is discussed in section 15 to 17. The salary income of an employee is to be computed in accordance with the provisions laid down in sections 15, 16, and 17. Section 15 gives the scope of this head and tells us that which income shall form part of this head. Section 16 gives deductions to be allowed out of incomes taxable under this head. Section 17.1 defines the word salary. Section 17.2 and 17.3 defines the terms perquisites and profits in lieu of salary. The chart on salary. Salary is discussed under 15, 16, 17. Plus allowances plus perquisite plus profits in lieu. These should be less with from entertainment allowance and tax on employment. This whole gives you income under the head salary. Definition of the word salary. According to section 17.1, salary includes the following amounts received by an employee from his employer during the previous year. They are wages, any annuity or pension, any gratuity, any fees, commission, perquisites or profits in lieu, or in addition to any salary or wages, any advance salary, any payment received by an employee in respect of any period of leave not availed by him. That is called leave encashment. The annual accretion to the balance of the credit of an employee participating in a recognized provident fund. The taxable portion of the transferred balance from unrecognized provident fund to recognized provident fund. The contribution made by the central government or any other tax employer in the previous year to the account of an employee under pension scheme referred in the section 80 CCD. Section 15. Basis of charge of income. The basis of charge in respect of salary income is fixed by section 15. The salary is chargeable to tax either on due basis or on receipt basis, whichever matures earlier. Any salary due in the previous year, whether paid or not, any salary paid or allowed to him in the previous year, though not due or before it becomes due to him. Any arrears of the salary paid or allowed to him in the previous year, if not charged to income tax for any earlier previous year. Any salary, bonus, commission, or remuneration by whatever name called, due to or received by the partner of a firm from firm shall not be registered as salary for the purposes of this section. The characteristics for computing salary income. For any payment to be made taxable under the head salaries, it must fulfill the following characteristics. In case any receipt is not covered under any of these features, it will not come under this head. They are relationship of employer and employee, salary from more than one employer, salary from present, past, and prospective employer, tax-free salary, salary received as member of parliament, receipts from persons other than employer, places of accrual of salary income, deductions made by the employer, salary as partner, payments received by legal heirs of a deceased employee, payment made after cessation of employment, voluntary foregoing, application of salary, previous years for salary, taxability of salary on due or receipt, whichever is earlier basis, salary grade or pay scale, advance salary received, arrears of salary received, salary in lieu of notice. So this is a slide showing everything in a nutshell. How to compute salary income? That is, first thing, basis salary, pension, annuity, bonus, commission, arrears of salary, advance salary, everything compute, add and make one amount. Then add gratuity, leave encashment, computed pensions and allowances after claiming exemption, if any, under section 10. Then add perquisites and profits in lieu of salary. This gives you total uh, income and employer's contribution to provident funds in excess of 12% of salary of the employee, interest credited to the RPF in excess of notified amount. This all gives gross salary. Now we need to deduct some things like deductions allowed under section 16. They are standard deductions, entertainment allowance, employment tax. So five points need to mention in your computation of salary income, that is basic salaries, pensions, gratuities of amounts, commissions, and adding the gratuity value of perquisites and profits in lieu, employer's contribution to provident funds, interest of the provident funds. All these in a nutshell gives you gross salary, and you need to deduct those deductions allowed under section 16, that is standard deduction, entertainment allowance, employment tax. This gives the total income chargeable under the head salaries. Thank you. Please like, share, subscribe and comment. Thank you.